Hey everyone, just decided to make a short video here because I get this question every day from business owners, and it's just, why is my profit and loss showing profit, but I don't have that money in the bank? Like, where does that go? What is the difference? And they seem to be, confused on that, so I'm here to clarify it. So I'm on the sample company for QuickBooks, so this is not real data. But if you go to reports on the left hand side and then go to profit and loss. All right, so we have your profit and loss statement here. And then we have net income of $1,186.21, right? So your profit and loss shows your sales, which are deposits that are coming into the bank from your clients, and then shows all of your direct costs and your operating expenses, right? So your direct costs and operating expenses are just normal daily expenses that you're incurring within your business for the jobs that you're providing. It could be for the normal operating costs like marketing, salaries, advertisements. But what is not on the profit and loss that's coming out of your business account as a cash expense are some balance sheet items. So that's where those expenses go. They don't go here. I shouldn't say expenses. Those are where some of your cash outflows are going. They don't go here on your profit and loss, right? They are actually getting recorded on your balance sheet. So that's why you're not seeing that same amount on the profit, your profit, so here's your balance sheet, and I'm just going to go straight to those sections where that's making a difference in your bank account. So, okay, so if you have a loan, for example, you financed a truck and you pay for $500 a month, that's not going on your profit and loss. Therefore, your net income is higher. Where that's getting recorded is here in this section, where maybe in your balance sheet it says loan payable Ford or something like that, or F-150 loan payable. And so if I click on this account, again, this is a sample company, so it might not show up. So what happens is the original loan balance is $25,000, right? But every month you're paying $500. Those $500 would get recorded here to lower that loan balance. The reason why that's on your balance sheet and not on your profit and loss statement is because it's associated with an asset. That loan is associated with an asset. You have that loan because you purchased that F-150, which is up here, the truck, right? And what happens is that that expense, that $25,000 loan that you incurred, is not going to go on your profit and loss because you're going to depreciate it over its lifetime, little by little, versus and then that $500 is going towards a loan on your balance sheet. Again, it's on your balance sheet because it's associated with an asset. It can't go on your profit and loss. It's here, and it pays that loan down. So right now it's $25,000, but at the end of the year it may be $19,000 that's left on that loan balance, right? What does get recorded on your profit and loss though is out of those $500, right, maybe $50 is interest expense. So every month your bookkeeper, accountant, or yourself, you go in here and it's categorized towards that loan, right? But then you will click into that $500 and you would put only $450 towards that loan balance, towards the $25,000, but then you would recategorize the rest of the $50 towards interest expense. And interest expense is on the profit and loss statement. So that's one of the things that why, are reasons why your profit and loss, your profit on your income statement is not the same as the bank, because it is a cash outflow. The $500 is a cash outflow, but it's not getting recorded on the profit and loss statement, right? Another thing is if you purchase large equipment or assets, or that's not getting recorded on the profit and loss. That's getting recorded here. So let's say you purchase a skid steer for $10,000. That's on your balance sheet. That $10,000 is not going to go on your profit and loss statement. Therefore, your bank is not going to mirror what your profit and loss statement is saying, because that $10,000 is going to get amortized over the next couple of years that you're using that asset, right? Because you're not going to use it all at once. So those are some of the reasons why your profit and loss statement, your profit, your net income doesn't match what's in your bank, right? You say, okay, I have net income of 20,000. I wish I had that in my bank, right? But it's not. And then actually, I just remembered another key item is owner's draws or owner's withdrawals or shareholders distributions, whatever you want to call it, is so those are items that you're spending with your business card. So if you go into Macy's, it's personal expense, or I don't know, you go to Disney World with your kids or whatever, and you spend that on your business card, right? That doesn't go on your profit and loss statement because it's not a business expense. It's going here. It's actually decreasing your equity. It goes in owner's draws or shareholders distributions. And that also is on your balance sheet. That's not going to show on your profit and loss statement, right? So that's another big one there. And what that does is it decreases your equity in your business. So it's always important to keep personal and business separate. And so if you really want to get like a good report, you can go to reports, and like a cash report is what I'm saying, and you go to cash flow, statement of cash flows. So this report will match what's in your bank, because this is a statement of cash flows, cash inflows, what's coming into the account, which would be sales, any deposits from any other sources, and then cash outflows, which is all of your expenses, your loan payments, everything, right? So that's what's in your cash flow statement. So this is something that's supposed to match the bank. So you show your net income here, like I said, your net income, but then there's adjustments made to that in net income so that it shows the cash at the end of the period. So if you see one of the adjustments to the cash flow statement is the loan payable, the $4,000 notes payable. So that's really what your true cash is going to be on hand at the end of the day. So it's important, very important, to look at your cash flow statement and seeing all of your cash inflows and outflows for the month, and getting a good grip on, okay, on average, my cash outflows are $14,000 a month and my cash inflows are $25,000 a month. That's how much I need to have in the bank every single month, and I need to have a cushion of, maybe we'll work up to a cushion of 6 months worth of those worth of that, because what if something happens, and you're not generating as much revenue, but that in order to sustain the company, you need $14,000 per month in the bank to cover all of your expenses. So it's really a good statement to look at, and I hope that this clarifies why your profit and loss statement, your net income, doesn't match what's in the bank. And if you have any questions, feel free to reach out, but I just thought I would pop in here and shed some light on this. But I hope you guys are having a nice Friday. And well, it's Friday when I'm recording this, but and have a nice day there. Thanks.